So 2018, I think it's a year that global equity investors are very much willing to put behind them. It's a very, very difficult year, ending with most asset classes producing negative rates of return. That said, it was a year that I would like to divide into two different halves, pre-September and post-September. Pre-September markets were led by growth stocks, and particularly the FANGs, which is an acronym for Facebook, Apple, Amazon, Netflix, and Google. High growth stocks took the markets into new highs, and oil was trading up substantially, traded up north of $75 a barrel. And then September came along, and a risk adverse market seemed to take hold, where oil essentially collapsed, went down 40%. By December, growth stocks gave back all of their gains pretty much, and then some, and we produced negative rates of return across all indexes, and as I said, across most asset classes for the year. So the Canadian equity market is not very well diversified. It's very, very narrow in focus. It's dominated by financial services, the energy complex, and mines and materials. Oil in September traded north of $75 a barrel and then collapsed by year end. It was down 40%. That dragged that whole sector, the Canadian economy and Canadian stock market, down, producing really negative returns. On top of that, the financial services complex ended up with negative returns on the risks or the concerns around rising rates and what was going to happen in the underlying economy. We've enjoyed a particularly long period of very, very low inflation. But as the economy has performed quite well over the last couple of years, inflation itself has started to creep higher. Central bankers who had been providing massive stimulus over the last almost 8 to 10 years in order to support economic growth have started to raise rates at the margin so that they don't get behind the curve. They don't want inflation to get out in front of them and then have to jam on the brakes. So they're slowly raising rates, trying to curtail inflation. But as we see it right now, it's not a huge risk. The underlying economies generally look pretty solid. It's not robust growth by any measure, and a little bit of inflation is actually healthy. So I think recession risks right now are overblown. Certainly there's a recession out there, but we don't see it as a near-term risk. Just looking at the economic data, unemployment rates in Canada, the US are historically low. In fact, in the United States, the unemployment rate of 3.7% is the lowest in 50 years. We've talked about a little bit of inflation creep, certainly, but other data, manufacturing data, which comes out every month, says that the economies are continuing to expand. Retail sales are continuing to grow, housing starts, things like that. So although the economies are slowing at the margin, recession risks, as we see it, are somewhat distant right now.